Hello everyone, and welcome back to Dr. Tao's Quant Lab. Today we are deploying a classic barbell strategy. We are looking at the momentum and value 7. Fortinet, Intuitive Surgical, Lululemon, MRVL Technology, PayPal, United Health Group, and Block. We are going to analyze a unique cross-section of high beta tech disruptors and defensive beaten down value anchors. By applying our forward-looking expected target model across all 7 of these very different assets, the math is going to clearly expose the gap between grounded fundamental gravity and pure momentum premiums. Before we dive in, please note the disclaimer on the screen. This is an independent educational project. The views expressed are my own, and this is strictly for educational purposes, not financial advice. If you want to study the underlying mathematics of these models, please refer to section 1.7 of the main Quant Lab course. To understand exactly what the market is pricing in, we map out a stock's gravity using our valuation thermometer. Please feel free to screenshot these slides as we go through them so you can study the coordinates later. This is how to rate the 3 core segments on our dashboard. Range 1, the blue box, is the deep value floor. This is the absolute worst case scenario pricing based on straightforward estimates. If a stock falls in here, it is experiencing massive market capitulation. And then range 2, the red box, is the expected target. This is our core fundamental fair value zone. The middle of this box represents the historical median multiple. If a stock has heavy stock-based compensation, we will also plot an orange box representing Wall Street's adjusted non-GAAP expectations. Then stat range, the purple box, is the micro-statistical boundary. This uses a mathematically normal 90-day standard deviation band to show us the immediate short-term algorithmic momentum. Finally, at the bottom of each matrix, we track 3 vital dates. The last report date, the next report date, and the statistical analysis date. Do not ever trade on obsolete data. Let's look at the chart. We're kicking off with the cybersecurity space. Let's pull off FTNT. The current price is about $81. Fortinet is the highly profitable cash-generating machine. Take a look at this incredibly tight convergence on the chart. The current price, $81, is sitting almost exactly on the midline of its 90-day microstat range. But look at where that momentum band is packed. It is perfectly aligned with the absolute ceiling of our fundamental macro expected target. So this is a rare, perfectly priced chart. The stock is fully valued based on its maximum forward fundamentals. And the short-term momentum algorithms agree down to the penny. If you are holding on the right side, you have beautiful mathematical support here. But for left side buyers looking for deep value, there is zero discount. You are paying absolute top dollar for execution. So you need to wait until it go back to around $51. Moving to the healthcare side of our barbell, we have Intuitive Surgical, ISRG. This premier medtech robotics company provides a critical lesson on adjusting fundamental multipliers for true monopolies. The current price is 468. If we used a standard market multiple for ISRG, the fundamentals would look completely detached. But because of ISRG's technological moat in medical imaging and surgical robotics, they command a structural premium. By evaluating our expected target multiples, the fundamental picture instantly snaps into focus. The current price, 468, has recently dropped below the floor of its 90-day macro stat range. In a normal momentum stock, breaking algorithmic support like this is terrifying. However, because we correctly adjusted our microgravity boxes, you can see the price is actually falling right into the upper half of its fundamental non-GAAP target, the orange box, and sits safely above strict GAAP resistance, or the red box. This completely changes the narrative. Instead of a momentum breakdown into an air pocket, this is a healthy, structurally supported pullback. The stock is simply cooling off from its statistical momentum premium and returning to its premium fundamental fair value. Now, we'll arrive at the customer discretionary side with Lululemon, LOULU. The current price is 146. I want everyone to look very closely at this chart because this is the most dangerous visual in the entire quant lab. It is the exact definition of a value trap. The current price is completely isolated on the left side of the screen. It has violently broken below its 90-day purple statistical range. And it is trading astronomically below the absolute floor of its historical microgravity, the blue range 1 starting at 199. If you look at this purely through historical math, it screens generational buying opportunity. Do not buy this chart right now. Why? Because Lulu is projecting negative growth for the current year, where macro boundaries are based on historical multipliers. But the multiplier is entirely useless if the earnings are actively shrinking. For left side value buyers, you must wait for the earnings decay to bottom out before you try to catch this falling knife. Now let's shift into the semiconductor and AI infrastructure side. Here is MRVL technology, MRVL. The current price is 95. If you want to see what a fundamentally supported momentum breakout looks like, this is the textbook example. Look closely at the current price of 95. It has just popped above the absolute ceiling of its 90-day macro statistical momentum band, $90. Short-term algorithms are running hot. However, look at the macro picture. The price is perfectly enveloped inside the lower half of its structural expected target, the red box, which reaches all the way up to 131. This is a green light for right side momentum traders. Yes, the short-term band is stretched, but it is heavily backed by real forward-looking fundamental growth. The stock has significantly room to run just to reach its historical median fair value of 105. Next, we have a classic fintech turnaround play, PayPal, trading at 44. Later in this section, we will look at Block or XYZ acting as the high beta momentum fighter in the payment space. PayPal, however, represents the exact opposite end of the spectrum. It is currently acting as a heavily soup-priced value anchor. The current price 44 has pierced the absolute floor of its 90-day purple statistical range. And it is trading a full $10 below the start of its historical deep value floor, or $54. The market has entirely abandoned PayPal's historical fundamental gravity. On paper, a stock trading below range 1 looks like an immediate deep value accumulation zone. But I must issue a critical warning here. The digital payments industry is undergoing structural trauma. We are seeing massive margin compression and heavy competition from Apple Pay and Stripe. If you buy this simply because it is below the blue box, you risk falling into a value trap. Left side buyers must wait for defensive proof of earnings stabilization. Now we arrive at the absolute anchor of our barbell strategy, where we are looked at high-flying momentum and value traps. United Health Group represents the defensive, low volatility, left side value play. The current price is 262. If you are a value investor, this is the exact visual you are hunting for. The current price, 262, has completely fallen out of its macro expected target, the red box, violently broken below its 90-day statistical range, and is now resting directly inside the blue box, the deep value floor. It is sitting pennies away from the absolute selling of range 1 to 63. A stock falling into the blue box means the market is pricing in near worst case scenario multiples on its forward earnings. For momentum traders, this chart is broken. But for left side accumulation buyers, this is a phenomenon mathematically sound entry zone. You are buying a cash-generating healthcare titan at a severe historical discount, locking in a margin of safety. We are closing out our barbell with Block, trading under the ticker XYZ. Earlier, we looked at PayPal as the suppressed value anchor. Block represents the high beta, high volatility disruptor wing of the fintech space. The current price is $57. Because Block is known for wild momentum swings, we need to map out its risk profile very carefully. The stock has recently experienced a significant pullback. The current price 57 has dropped down to rest almost exactly on the absolute floor of its 90-day statistical range. Simultaneously, it is sitting very safely inside the lower half of its macro expected target, or the red box spanning 48 to 81. For a volatile momentum asset, this is exactly what you want to see before initiating a position. It is a technical cool-off that has landed directly on both mathematical short-term support and long-term fundamental fair value. Okay, that wraps up our momentum and value 7 analysis. Today we deployed a true barbell strategy. We saw exactly how the expected target model visualizes both extremes of the market. We mapped the structurally supported premiums on disruptors like MRVL and intuitive surgical, and we contracted them directly against the grounded value anchor of United Health and the dangerous value traps hiding in Lululemon and PayPal. The math never lies. It is simply simplified, shows you what the crowd is willing to pay. It is your job to decide if the crowd is right. If you want to replicate this dashboards, all the notes are in section 1.7 of the Quant Lab. Thank you for watching, and I will see you in the next section.